So very clearly, unit trust has an advantage, and Cal will have an advantage because of the longer term maturity of the fund. The other asset class which is now gaining popularity is equities. Right now, historically, and in terms of the market today, the all share price index is trading at somewhere around 11,000 to 11,500 levels. We are looking at the market can even touch 13,500 to 14,000 levels in the next 12 months, right? And I'll tell you why we expect this and why the stock market can be an attractive proposition right now, right? So historically, if you look at it, interest rates and all share price index have a very strong correlation, right? And how it works is that when interest rates come down, we've seen market goes up and vice versa, right? So why? Because if, for example, if interest rates are very low, to be honest, people or investors don't feel that it's sufficient amount of money that they are making in terms of return, right? So they look at alternative asset classes, right? The alternative asset classes, Sri Lanka has a very few alternative asset classes, right? So equity is one particular product, right? So if even 1% of FD mature and come into equities, we see roughly about 10-15 billion rupees of money coming into the equity market, which is a large amount of money, which can push the equity markets very high, right? So if you look at it, there is a very negative correlation, very high negative correlation between interest rates and the equity market, right? And now with tax-adjusted FD rates being lower, right? Now we know that if you put a FD at 11%, you're only going to get 7% to your hand, right? And very soon that 11% rate will also reduce because when central bank reduces rates, your FD rates are going to keep coming down, right? So the tax-adjusted FD rates don't make any sense at all, right? When you compare it with for investors, which will make them to look at alternative options like equities, right? And one particular product that that people come into is equity. So the trick is, before everyone starts coming in, you need to start entering into the equity market, right? Now, we've seen 2-3 quarters of bad earnings growth, right? Companies were doing badly. But now you're seeing economic growth coming back, right? Which means that companies will start doing better. Interest costs of the companies are coming down. So corporate profits also will start improving from the December quarter onwards, right? So that also will kind of help the companies revalue itself in the market, right? So share prices will move up when profit starts improving. So this also helps the momentum to continue in terms of equity market. And all share price index and credit growth have very strong correlation. Now we are seeing, if you look at last month, was the first time we've seen after 14 or 16 months that private sector credit has turned positive. That means that people are now starting to gradually borrow, right? And in a period like that, we've seen strong correlation between the credit growth and the all share price index, right? So that will also kind of help for the market to kind of move up, right? So how do you gain exposure to equities, right? How do you invest in the share market, right? So either you can invest directly in the stock market by opening your account and trading in the shares, right? For that, you need to have a little bit of understanding how things work. Obviously, Cal will help you through the platforms in terms of giving the support, the necessary recommendations, the platform, and even a research database, which we launched a week ago into what is called Analytica. So the platform is given in terms of if you have a time to trade in the market, right? But say, for example, if you're a passive investor, you don't have time to do this. You don't have time to kind of spend in investing in the share market to find what good shares are, do your own research. Then we would recommend taking the unit trust fund route, where the unit trust fund, we have a specially dedicated equity unit trust fund, which invests in the share market. That's what you call as a quantitative equity fund, right? So you just put the money in and the fund managers will kind of manage those funds for you, right? So that's a passive approach, right? But if you are someone who would like that kind of the kind of active trading, then we prefer you to take the direct investing route in the equity market, right? So this is the fund performance. I mentioned to you about the equity fund that Cal manages. This is what you call the Cal quantitative equity funds. If you have invested 10 rupees in 2013, obviously your return today is almost like 40 rupees today, right? So over roughly about 10 years, right? Even though markets have been choppy, country has been doing well, the performance of the portfolio can be seen here, right? So roughly, if you work out a weighted average return for a year, it works out about 15% per annum on an annual basis, right? So this is in a bad time when economy was not doing too great, right? Obviously, we had struggles in 2019, 2021. Even in this period, we've been able to outperform the market by a large amount, right? So one option is taking the route of investing your money through a stock market account, a stock market unit trust fund, which we call as a Cal Quantitative Equity Fund. So you can either take a passive approach and put money in the equity fund and make returns through it, right? Keep in mind that equities always has a downturn risk, right? Because downside risk, right? Equities can always come down in value if there is a reduction or change in economy. If economic fundamentals change, yes, the equity market can come down. But also there is a benefit in terms of taxation, right? Equities is zero taxed in terms of the capital gains that you make, right? So if your share price goes up from 10 to 20, you don't have to pay a tax on the gains, right? The only tax that you pay is on the dividend income, right? So if you make a dividend, you pay 15% tax on it, right? If the company declares a dividend, you pay a 15% tax on it. On the capital gains, you don't pay any tax at all, right? So that's a brief in terms of what we're looking at and what we can recommend to our investors. So at the moment, easy route would be taking the unit trust funds. Second is equities in terms of the share market. And also when debentures come out with attractive rates. So you have to be careful in terms of what rates you invest. It should give you a return higher than the treasury bonds. And also you need to be wary of what kind of credit quality those instruments are, right? So these are important when you're making a choice in terms of what investments that you kind of make, right? So on that note, let me take a few questions.